Last year, one American company reported a profit of $1.9 billion, nearly 5 times what it earned the year before. In the same report, signed by the same auditors, the cash the business actually generated went up 13%. Not 5 times, 13%. Both numbers are true, both are legal, both were audited. And the gap between them is the most important thing you will ever learn about reading a company. Profit is an opinion, cash is a fact. Forget companies for a minute, you sell lemonade. Saturday morning, you sell $100 of lemonade. That is your revenue, the money the world handed you for your product. Revenue is the top line. It is the easiest number to understand and the easiest to be impressed by. Now the costs: lemons, sugar, cups, $60. 100 minus 60 is 40. That is your profit, simple. Except nothing about that Saturday was simple. The lemons, you bought them on Thursday, in cash. $60 left your pocket 2 days before you sold a single cup. And your biggest customer, the office down the street, took 200 cups for the whole team and said, "Invoice us, we pay in 30 days." So on Saturday night, your books say, revenue 100, profit 40, and your pocket says minus 60. You are profitable and you are broke. That is not an accounting error. That is how almost every business on earth works, and it is why you need a third number. Cash is what actually moved, not what you earned, not what you are owed, what moved. Revenue is a promise. Profit is a calculation. Cash is a fact. 3 numbers, 1 Saturday, all of them true. Let's build these numbers properly, because from here on you should be able to do this yourself. Start at the top, revenue, everything you sold. Take away what the goods themselves cost you, that is gross profit. Take away the cost of running the place, wages, rent, marketing, that is operating profit. This is the one that tells you whether the actual business works. Take away interest on debt and tax. What is left at the very bottom is net income, the bottom line, the number that gets printed in headlines. Our lemonade Saturday, $100 of revenue, $60 of lemons, $40 of profit. You just did an income statement. Now the second calculation, and this is the one almost nobody learns. The cash flow statement does not start from scratch. It starts at that same net income. And then it strips out everything that was never cash. Watch it on a real company. Carvana's 2025 annual report. Start at net income, $1.9 billion. Now take out the things that brought in no money. The largest single one is that $2.2 billion tax adjustment, an accounting reserve being released, real profit on paper, $0 in the door. Adjust for the timing of money owed and money paid, and you land at the number the business actually generated, $1.04 billion. Same company, same document, same year. And notice which number you get told first. Every public company hands you 3 documents, and they answer 3 different questions. The income statement, what did we earn? Revenue at the top, profit at the bottom. This is the story the company tells. The balance sheet, what do we own and what do we owe? A photograph on one single day. And the cash flow statement, what actually moved? This one is the lie detector. Beginners read the first document, professionals read the third one first. Let me show you why. In 2014, Amazon reported a loss of $241 million on $89 billion of sales. By the income statement, Amazon was failing. That same year, $6.8 billion of cash flowed into the business from its operations. Profit said this company is losing money. Cash said this company is a machine. Cash was right. By 2025, Amazon reported $77.7 billion of profit and $139.5 billion of operating cash flow. The people who only read the profit line missed one of the greatest businesses in history for a decade. So why did profit get it so wrong? Because profit is not found, it is assembled by people making choices. Here are 3 dials that every finance chief has a hand on, all legal, all disclosed. Dial 1 when a sale counts. You sign a 3-year contract today. Do you count all of it now? A third each year? The rules leave room, and where there is room, there is a choice. Dial 2 how fast things wear out. Buy a $10 million machine. You do not subtract 10 million from profit today. You spread it across the machine's useful life. Say it lasts 5 years, 2 million a year. Say it lasts 10, 1 million a year, and your profit is $1 million higher. Same machine, same cash, different profit. Dial 3 what counts as one time. Restructuring, settlements, write-downs, set them aside and your adjusted profit looks a great deal cleaner. Now watch, turn the dials and the profit number moves. And cash does not move at all. The money in the bank does not care which dial you turned. Numbers don't lie, people make the numbers. Now this is not a story about villains. Those dials exist because business genuinely is complicated. Used well, they tell the truth better than raw cash ever could. So let me show you 2 companies that are honest about it. Costco, in its 2025 financial year, Costco sold $275 billion of goods. Its operating margin, what it keeps from each sale, was 3.8%. That is thin, deliberately thin. Costco's entire strategy is to sell you things at almost no markup. So where is the money? Membership fees. $5.3 billion paid up front before you buy a single item. More than half of Costco's operating income comes from a fee you pay in advance. And look what that does to cash. Costco's operating cash flow was $13.3 billion against $8.1 billion of profit, over $5 billion more cash than profit. Because the members' money arrives before the accountants are allowed to call it earnings. Thin profit, enormous cash on purpose. And Amazon, again, for the opposite reason. For a decade, it deliberately spent its profit away into warehouses and servers and let the cash line tell the truth. Both honest, both look wrong if you only read one number. Now let's dust some numbers for fingerprints, 4 levels, and only the last one is a crime. Level 1, Boeing. When Boeing builds a brand new aircraft, the first ones are ruinously expensive. New tooling, new factories, workers learning as they go. So the rules let Boeing average the cost across 1,000 future jets it has not built yet. It is called program accounting, and it is disclosed in Boeing's own filings. Which means the early 787s, planes that cost far more to build than they sold for, still recorded an accounting profit. Where does the difference go? Onto the balance sheet, a line called deferred production costs. By March 2016, that pile had reached $28.6 billion. By the end of 2025, it was down to $13.9 billion, as later, cheaper planes paid it back, which is exactly how it is designed to work. Every step legal, every step disclosed, and at every step the profit line said something the cash never did. Level 2, Uber. In late 2021, Uber announced a milestone, its first adjusted EBITDA profitable quarter, $8 million. In that same quarter, under standard accounting rules, Uber lost $2.4 billion. Adjusted plus $8 million, actual minus $2.4 billion, same company, same 3 months, same press release. The word doing all the work is adjusted. Uber's first genuine full-year profit came in 2023. Level 3, and this one is happening right now. Carvana, the company from our opening. Its 2025 annual report, profit of $1.9 billion, nearly 5 times the year before. Cash generated by the business, from $918 million to $1.04 billion, 13%. So where did the rest of that profit come from? The filing tells you. $2.2 billion of it was a one-time, non-cash tax adjustment, an accounting reserve being released. Carvana's own auditors flagged that item as a critical audit matter. Nothing hidden, nothing illegal. It is right there in the document in plain English if you read past the headline. Most people don't. Level 4, Enron. Enron's own annual report claimed $979 million of profit for the year 2000. Its method, booking estimated future profit today on deals stretching decades ahead. Enron's own board-commissioned investigation later found that off-balance sheet partnerships had inflated its earnings by almost $1 billion. That one was a crime. People went to prison. And one last warning, so you do not leave here overconfident. In June 2020, the German payments giant Wirecard admitted that its auditors could not confirm 1.9 billion euros of cash, roughly a quarter of its entire balance sheet. 4 days later, its own board said the money probably never existed at all. Cash is a fact, but somebody still has to check the fact is real. So here is what you do tonight. It takes 10 minutes and it does not require a single thing you have not just learned. Pick any company you are curious about, one whose products you actually use. Search its name plus investor relations plus annual report. Find 2 numbers, net income and net cash provided by operating activities. Write them down for the last 3 years, side by side. 3 patterns. 1, cash consistently higher than profit, usually healthy, that is a Costco. 2, the two move roughly together, normal. 3, profit consistently higher than cash, year after year after year, that is your flag. It is not proof of anything, it is a question. It means somebody is making choices and now you want to know which ones, and the filing will tell you because it has to. 2 numbers, 3 years, that is it, and it puts you ahead of most people who buy shares. If that was useful, subscribe. This is a school and it works in order. Next we take apart the number that sells you everything, the return. Every episode is built from the company's own filings, which takes a while, and subscribers are genuinely what lets us keep making them. You are not being lied to, not usually. You are being presented to. Every number in a financial report was assembled by a person, with an incentive, a deadline, and a range of perfectly legal choices. Your job is not to catch criminals. Your job is to know which number you are looking at and who chose it. Profit is an opinion, cash is a fact. Numbers don't lie, people make the numbers. Which number should we dust for fingerprints next? Tell us and we will. This is education, not financial advice. Every company named here is discussed using its own public filings.